Sony's semiconductor business just posted its highest first-quarter operating profit ever. But the real story here isn't the strong numbers themselves. Sony is steering toward becoming a company that doesn't quit semiconductors, but no longer carries them heavily. That, I think, is what will reshape the industry map going forward.
Hello everyone, I'm Ty, with 31 years in the semiconductor industry. Today, I'm covering Sony's first quarter results for fiscal year 2026. By the end of this video, you'll understand from a professional's view why strong earnings didn't lift the stock and how Sony plans to grow its image sensor business from here. Let's start with a familiar analogy. Picture a shopping district with one large group of stores, a restaurant, a movie theater, a game arcade. Public attention always goes to the glamorous restaurant and the movies. But what the world actually rates most highly is the special sauce made in the back workshop. That sauce is world-class in flavor, and the finest restaurants insist on it by name. Lately, orders have shifted toward richer, more premium sauce, so the price per bottle keeps rising. The number of bottles sold barely grows, yet revenue and profit climb steadily. This quarter, the sauce workshop became the group's biggest earner. But making this sauce comes with a serious headache. It needs enormous vats and dedicated equipment, and every few years you have to replace them with the newest models or lose the flavor race. You pay huge money up front before the orders arrive and keep repaying the debt on that equipment. On paper, you're profitable, yet far less cash is actually free in hand than you'd expect. On top of that, the workshops are concentrated in a few locations, so an earthquake or disaster stops production all at once. In fact, a recent earthquake shut down the main workshop. Owning everything yourself is profitable, but heavy. How to deal with that weight has been this group's long-standing worry. So the owner came up with two moves. First, team up with one of the world's largest food plants and make the sauce in a shared workshop, keeping the recipe and the final say on flavor while sharing the weight of the equipment. Second, stop at selling sauce by the bottle and extend into a full service built around dishes that use it. From here, let's look at how this simplified story is actually playing out in the real industry. On July 31st, Sony Group announced its first quarter results for fiscal 2026. The Imaging and Sensing Solutions segment, I&SS, its semiconductor business, posted revenue of 512.7 billion yen, up 26% year-on-year. Operating profit rose about 2.2 times, from 54.3 billion to 122.2 billion yen, a record for a first quarter. The driver was image sensors for smartphones. Even without big growth in handset units, high-end models keep moving to larger, more capable camera sensors, so the sensor value per phone rises. This is earning through higher value, not higher volume. Foreign exchange also helped, adding 23.2 billion yen to this segment's operating profit. Group-wide, revenue rose 8% to 2.838 trillion yen, and operating profit rose 40% to 476.5 billion yen. Sony also raised its full-year guidance to 12.5 trillion yen in revenue and 1.72 trillion yen in operating profit. Yet the stock briefly gained about 4% after the announcement, couldn't hold it, and closed down 0.6%. The results were respected, but they didn't create expectations of rapid growth. Another key fact is the Kumamoto earthquake on July 28th. The Kumamoto Technology Center, one of Sony's main sites, halted production right after the quake, and recovery work continues. Sites in Nagasaki, Oita, and Kagoshima had no major damage and have resumed production. Because the impact of Kumamoto can't be reasonably estimated at this point, it isn't reflected in this guidance. Now to the main point. Most of the commentary centers on strong earnings that didn't lift the stock, but that isn't what I think deserves attention. The real question is the fork in the road on capital allocation, where Sony will direct the money it earns from here. Looking coolly at the numbers, 23.2 billion yen of I&SS's roughly 68 billion yen profit increase came from currency.
For mobile sensors, the gain looks driven less by volume expansion than by customer and product mix, plus the weaker yen. We shouldn't read all of it as underlying strength. Still, if I had to name one business where Sony holds clear global competitiveness, I'd say image sensors, not gaming or movie IP. Sony invests aggressively in IP. Games, music, film, anime. If a title hits, you can expand without building factories, and I understand the logic on capital efficiency. But if you ask me to name Sony's flagship IP, it's hard. Spider-Man is powerful, but Sony doesn't own the character itself. Realistically, it's difficult to call it as dominant as Mario or Pokemon. That's exactly why I think it's more natural to expand from sensors, where Sony already holds a top-tier global position. Not selling sensors as a component and stopping there, but connecting see, judge, and move. The partnership with Mitsubishi Electric, announced on July 22nd, is the entry point. Sony's sensor captures the image, AI makes the judgment, and Mitsubishi Electric's factory automation equipment moves the machinery. Go that far in, and you capture value as an industrial vision system, not as a component unit price. The biggest wall, meanwhile, is the weight of manufacturing. Massive investment in fabs and tools, depreciation, and utilization risk. You commit hundreds of billions of yen before demand appears, and each generation change demands the next round. The basic agreement with TSMC, announced in May, looks like an answer to this. They're studying a joint venture, majority held by Sony, plus development and production lines using a new plant in Koshi City, Kumamoto, with Japanese government support assumed. In other words, I read it as Sony not wanting to quit semiconductors, but not wanting to carry them heavily. Keep the tastiest parts: pixel technology, stacking technology, design, and customer relationships, while stepping away from being a heavy semiconductor company that owns all of its production equipment. The two companies have also pointed to automotive and robotics, the physical AI domain. Now the impact on Japan. The TSMC plan assumes investment in domestic sites like Kumamoto and Nagasaki, along with government support. So if it advances, it's a tailwind for Kyushu's manufacturing base. At the same time, as the Kumamoto earthquake showed, holding production sites sits right next to disaster risk. Sony's motive to spread out the burden and risk of manufacturing connects here too. On shareholder returns, the annual dividend is planned at 35 yen, up 10 yen from last year, but the payout ratio stays just under 20%. There's a target of roughly 40% total return, including buybacks, yet the question is where the retained cash gets reinvested. Buying up IP? Expanding the game economy? Or evolving world-class sensors into the eyes of physical AI? That's what's being tested. To sum up, Sony's semiconductor business posted a record first-quarter profit, driven by higher-value image sensors. But the stock stalled, and the market is waiting for the next growth story. Grow the technology and the profit without carrying semiconductors heavily. Whether that capital allocation succeeds is, I think, a more important issue than these strong results themselves. That's all for today. I'll keep bringing you semiconductor news and analysis. So if you found this useful, please like, subscribe, and I'll see you in the next video. This has been Ty on Semiconductor News Decoded.